Welcome to the deep dive. Today, our mission is to wade through a really diverse stack of sources. We've got market reports, philosophical bits, even some, pointed commentary. And we're going to try and pull out the key insights about where the world is heading and maybe some of those surprising undercurrents.
Yeah, it's quite the collection. And it really paints this picture of a world in, well, significant flux. You've got traditional economics sort of bumping up against radical new tech, shifting geopolitics, the whole nine yards. The goal today is really to find those unexpected links, maybe challenge a few common assumptions you might have.
Okay, let's dive in then. Imagine Virginia Woolf providing the blueprint for blockchain. Seriously. Or thinking about why a multi-billion-dollar fart coin, yes, you heard that right, might actually tell us something important about, say, government bonds. It's going to be interesting. So let's start big picture, the U.S. economy. What are the sources saying? Well, it seems to be slowing down. From a brisk jog at 2.8% growth down to more of a wheezy shuffle at 1.2%. That's just in 6 months. But weirdly, the odds of a U.S. recession, they've dropped to an all-time low, apparently 11%.
It's a strange mix, isn't it? And what's really notable is the Fed's reaction, or maybe the lack of reaction. One source called their inaction the equivalent of a standing ovation, just keeping rates flat. And the bond market, eerily calm is the phrase used. The kind of calm you get before either enlightenment or a tornado. Makes you pause, doesn't it?
Definitely. And turning to stocks, the equity markets, it's still very much an AI story, right? NVIDIA keeps coming up. The high priest of pick and shovel profits, still dominating. This whole thing is framed as an AI arms race, building these huge language models that apparently need their own weather systems.
But there's this cautionary note, too, a reminder of the fiber optic bust back in 2000.
Yeah.
Infrastructure buildouts can get ahead of themselves.
Right. So what for you, the listener? Well, the advice seems to be own the market, but dance near the fire exit. But what's interesting is the idea you don't necessarily have to pick the next NVIDIA. If you're in the broader market, like the S&P, it kind of fattens itself on winners and quietly buries losers.
Yeah.
So you get that AI exposure, but with maybe a bit more of a safety net, hands-off diversification, almost.
Okay, let's shift gears. The digital revolution and blockchain. One source pulls out this amazing quote from Virginia Woolf. Nothing has really happened until it has been recorded. They call that blockchain's accidental mission statement. Kind of wild, right? It really is thought-provoking. The source digs into this, describing blockchain as this hysterical overcompensation, like we as a species don't trust our own memory anymore, so every banal purchase, every little click needs to be chiseled into eternity. It's like immortality, but maybe the most tedious sort, recording for compliance, not, literature.
Which brings us neatly to Bitcoin, and Jamie Dimon's view gets mentioned. He says he believes in stablecoins and blockchain, but not in Bitcoin. The source likens this to loving champagne corks in vineyards, but hating the actual wine. It's quite the takedown.
Yeah, it's framed as this almost ecclesiastical dismissal. The argument is banks hate Bitcoin not because it doesn't work, but frankly because it works too well. Why? Because it removes them from the altar. Bitcoin is positioned as the cathedral, stable coins. They're the teetotal cousins, maybe the choir boys. And blockchain is just the architecture on the roof. It's about control.
It is striking, though, how often you hear, ordinary people saying Bitcoin's too risky. And one source has this hilarious description. These are the same people, allegedly, who were double masking their toddlers during COVID, while simultaneously rolling over a 9% PCP, that's part finance, on a Nissan Qashqai to pay the vet bill for their neurotic cockapoo, eating fancy eggs, living in new builds, scrolling TikTok. But Bitcoin, that's the scam. The perception of risk is just fascinating.
It really is. A great example of how subjective risk can be, especially with new things, highlights a real bias and leads to that question. Is Bitcoin just a store of value, like Jack Dorsey may be implied? The counter-argument in our sources is strong. It's profoundly relevant. Why? Because it's censorship-resistant, borderless, and acts as sovereign-grade collateral. Yeah. Think about gold, a $22 trillion market. It hasn't bought a coffee or a house in centuries, but it's still hugely relevant. Bitcoin's value might lie in similar properties, not daily transactions.
Okay, so Bitcoin is one thing, but then there's Ethereum. And this is where it gets really interesting, because Ethereum isn't just trying to be better money. It's positioned as building a new digital foundation for how data, value, and identity move online. That sounds huge.
It is ambitious. The vision laid out is that in, say, 5 years, you won't consciously go on the internet. You'll just be using Ethereum-powered networks without even knowing it. Banks rebuild to smart contracts. Login secured on-chain. It's positioned as potentially the infrastructure play of the decade. happening behind the scenes.
But even with all this, growing potential for digital assets, retail investors still seem hesitant overall, and the numbers show it. Bitcoin's footprint in the S&P 500 is tiny right now. You add up Block, Coinbase, Tesla's Bitcoin, it's maybe $3.5 billion. Compared to the S&P's $53 trillion, barely registers.
Which just screams potential for future adoption, right?
Absolutely.
Especially from institutions. It feels like very early days in that respect.
Right. So moving from the big picture and the digital shift, let's zoom in on some specific companies. Bold bets, hidden gems. And you can't talk bold bets without mentioning MicroStrategy, MSTR, and Michael Saylor. Marmite Mike, as one source calls him, you love him or hate him. Their recent earnings described as so biblical, it should come with incense and a choir. Just incredible numbers. $32.60 EPS versus an expected loss. $10 billion in net income, all driven by their massive Bitcoin bet. And now they want to raise another $4.2 billion to buy more Bitcoin. They hold almost 630,000 BTC now. Average cost $73K. It's called a geopolitical weapon.
It's less a company, more a phenomenon now, isn't it? What do the sources say it's really become? They argue MSTR isn't just finance, it's theater, it's religion. The company became a vault, a vessel. It's loudly proclaiming that the old rules of money are increasingly dead. It's a statement piece as much as a strategy.
Fascinating. Now let's look at a tech giant, Microsoft. Their economics seem to be changing. Free cash flow margins down quite a bit, from 34% pre-AI to 25% now. The old model was write code once, sell it a million times, high margin. Now the sources say it's more like buy rapidly depreciating NVDA GPUs to fund cash-burning growth, and their actual free cash flow is down 4% year over year.
And that's a really critical observation. It's a warning sign, maybe. When markets are just focused on numbers go up, they might ignore things like return on investment, capital efficiency. But what happens if those top-line numbers slow down? People might start asking harder questions about this shift from high-margin software to high-cost infrastructure.
Okay, let's switch to biotech, a potential hidden gem. Cardiol, ticker CRDL, U.S. small company, $123 million market cap. But they have phase 2 data coming next week for acute myocarditis. This is described as an unclaimed frontier in cardiology. No approved drug, no standard of care. Big unmet need. And its cousin condition, recurrent pericarditis. That has one approved drug, a $2 billion market. Cardiol thinks their molecule could potentially treat both.
Yeah, this screams asymmetric alpha, as the source puts it.
Yeah.
That $123 million valuation feels like a misprint. They compare pericarditis treatment to finding gold and myocarditis to finding diamonds. The suggestion is the market is seriously undervaluing a potential game changer in heart disease. Huge potential if the data hits.
And just quickly, one more. Ford. There's an argument presented that Ford could massively boost profits, maybe EBIT up to $20–30 billion from $10 billion now. How? By stripping $10–15,000 of cost out of an F-150 if certain regulations were cleared. Imagine selling more trucks at, say, $35–40K and making bigger margins.
Right, and this points to a broader theme. Regulatory impact. Things like reforming the idiotic RIN credit system that's about renewable fuels, adds hidden costs, could unlock serious economic benefits. It makes you think about where regulation might be unintentionally stifling efficiency and profit, not just for Ford, but across the board.
Okay, thinking about value, let's bring back a classic warning. Scott McNealy, back in 2002, he had that famous rant about Sun Microsystems valuation, people assuming 10x revenues, 10-year payback with no costs, no taxes. He basically said, "You're nuts."
But here's the twist. Our sources argue that McNealy's rant is now a museum piece, especially when you look at AI companies. Why? Because these AI firms, they're writing the software that will run civilization. They're selling gravity, foundational stuff, and their costs. They scale like gossip, near zero marginal cost once the platform is built. So McNealy's assumptions, focused on traditional costs, become irrelevant. The market isn't counting coins in the till. We're arguing about who gets to actually mint them. It's a different game, as Darwin said. It's about adapting to change.
So if AI valuations reflect a new reality, maybe. Let's flip to a potential cautionary tale. Modern medicine hype, GLP-1s like Ozempic, described as a cult, a new gospel. Novo Nordisk, making it, has become Europe's fattest company by making other people thinner. The irony is noted.
And the concern here, drawn from history, is the pattern. Fen-phen, ephedra, amphetamines, they all had this biblical hype, but many ended badly. Organ failure, lawsuits, awkward silence.
Yeah.
The long-term side effects of GLP-1s are fundamentally unknowable right now. And there's this blurring line between medical necessity and aesthetic impatience. One source even speculates about a political backlash against this mass-medicated Vanity Fair.
Okay, so a counterpoint to that potential hype, something with maybe undervalued long-term utility, small modular reactors, SMRs. The projected impact on uranium demand is just huge. Sources suggest if we get just 100 to 200 SMRs online by 2040, which isn't that many really, for them on, that could drive 20,000 to 40,000 tons of annual uranium demand. That's potentially up to half of current global production. Massive implication.
Huge. Definitely something to watch in the energy space.
All right, let's shift focus again. Global geopolitics. Ukraine. Viktor Orban's recent statement is highlighted. Ukraine cannot be accepted into the EU. He argues it would upset the balance of power. And more concerning, perhaps, a move by the Zelensky regime described as decisive, gutting the National Anti-Corruption Bureau, NEBU, putting investigators under direct presidential control.
Yeah, the analysis on this is pretty stark. It's seen as a desperate scramble to hold on to power. And the potential consequences, widespread protests, Soviet fracturing, even a potential rapid collapse of Ukraine. Broader implications are also drawn, a potential sign of declining Western military power, possibly sparking a new and dangerous nuclear arms race involving more countries. It's quite sobering.
And related to global shifts, the recent EU-US tariff deal, how's that being portrayed? As a triumph for President Trump and a humiliation for a weakened EU. Tariffs mostly settling around 15%.
And connecting the dots. The argument goes that Trump's goal, beyond tariffs, is lower rates. There's speculation his administration might target the long end of the bond market somehow. And then this wild idea, stablecoins backed by U.S. treasuries. A genius, maybe mad plan?
The goal.
To get the world buying IOUs wrapped in blockchain confetti. But the potential downside could slash the dollar's purchasing power. Meanwhile, stablecoin issuers are reportedly stacking Bitcoin, just in case. It's a complex web.
Wow. Okay, back to Bitcoin for a moment. There's this really profound quote that keeps popping up. You will end up getting your Bitcoin at the price you deserve. Right, it's described as less of a prediction, more of a moral judgment, a karmic invoice. What does that even mean?
Well, it forces you to think about value and timing, right? And it ties into this idea of symmetry in the financial world. The source argues, why wouldn't a $1.4 billion fart coin exist? Why wouldn't it make symmetrical sense in a world where the supposed risk-free asset is a bond from a government with a 7-to-1 debt-to-revenue ratio, with off-balance sheet liabilities maybe 20, 30 times revenues? After 24 years of deficits, it's like building a cathedral on a swamp. The foundations of the old system look shaky, making the new weird stuff seem almost logical by comparison.
And traditional finance's reaction. Wall Street, the City of London, they're described as sulking like jilted debutantes. Why? Because Bitcoin slipped through their manicured fingers. They didn't invent it, they didn't control it early on, and crucially, they can't rig it like they do their precious markets.
So the current landscape is painted like this. The bond market is a dowager in a moth-eaten gown. Venerable, but maybe fading. Crypto. It's the drunk uncle at the wedding. Maybe unreliable, maybe loud, but at least the latter's honest about it. There's a raw transparency, perhaps.
But despite all the skepticism or sulking, institutional money is coming, isn't it? There's this tsunami just circling, sniffing, ready to jump in.
Absolutely. And this is leading to what's called the new asset allocation gospel from the crypto cognoscenti. It's suggesting a move away from the old, maybe dowdy 60.40 stock bond split. The new thinking includes digital assets explicitly. Maybe 0.2% crypto for conservative portfolios, 3-5% for moderate, 5-10% perhaps for aggressive. Alongside your stocks, bonds, real estate, etc. It's about rethinking portfolio construction for this new era.
Okay, we need proof of utility though, right? Beyond just price speculation. Helium, HNT, is brought up as an example of decentralized physical infrastructure. There's a quote from Thomas Edison used, anything that won't sell, I don't want to invent. Its sale is proof of utility. So helium basically crowdfunded a wireless network for the Internet of Things, and usage is growing. Explosive growth in data credit DC, burn, that's people paying to use the network. It went from like 189K as a month in March 2025 to 361K in June 2025.
And this is fascinating because major carriers are actually using it. AT&T, T-Mobile, Telefonica, through Solana smart contracts. Plus, Helium Mobile has these super low customer acquisition costs, $10 or $15 versus the usual $100 plus, probably because they offer a free basic plan. There's real magic here, the source says. It demonstrates that crypto can have real utility, building real-world things.
Okay, finally, let's wrap up with a stark reminder about currencies themselves. Project Zimbabwe.
You look at Zimbabwe's stock market, returns of like 903% in 2024. Sounds amazing, right? But then you see their M2 money supply grew 692% in the same year.
Yeah, these are not actually a series of coincidences. It drives the point home. Look at the S&P 500 priced in gold between 2004 and 2020, almost flat returns, but priced in US dollars, 7.8% compound annual growth. And when you know it, the USD money supply expanded at 7.33% over that same period. The takeaway is blunt. Most of the returns of the stock market aren't because stocks are getting more valuable, it's the currency getting less valuable. That really changes how you should view gains. Wow. Okay, we have covered a lot of ground today, a real deep dive. From the slowing economy and AI race, blockchain's weird origins, the whole Bitcoin debate, then specific company stories like MicroStrategy's massive bet, Microsoft's changing model, the biotech potential with Cardiol. We touched on regulation, valuation debates, geopolitics in Ukraine, trade deals. It really is a world in flux, redefining value itself.
I think if you connect all those threads, the core insight that emerges is this accelerating tension. Tension between the old systems built on trust, maybe manufactured trust sometimes, and these new systems built on hard math, distributed networks, verifiable code. Ultimately, it's a question of where belief is being placed,
Yeah.
in an increasingly, well, let's just say interesting world.
So the final question for you, the listener, to chew on, what does this all mean for you? We've talked about companies making biblical profits on Bitcoin, the very real possibility of currency losing value over time, the idea that stock gains might just be inflation. Maybe the most provocative thought to leave you with is this. In a world where even the risk-free asset, the government bond, is being seriously questioned, where do you actually find durable value, and how are you preparing for whatever comes next?
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.